Well, stocks did hit 13,000 today, but they didn't close above that level. The question is, where next? And we've got a distinguished panel here. We've got Jack Hough, Brett Arends, and Dave Callaway to help us answer that. Thank you very much for being here, guys. Three of the guys with the big sets of lungs in the company. Let's start with Brett. Always good to start with Brett. Where do we go after 13,000? Now it's been hit. Do we go straight down again?
I would never be so foolish as to make a short-term stock market prediction. In fact, I think one of the things people should take away from the last few years is the folly of, everyone wants to have a prediction about the market and no one really knows. Look, the average retail investor has been out of this rally. A lot of people dumped their stocks in 2008. And they've been on the sidelines ever since. The data is very depressing. People are out. We don't know what's going to happen next, and trying to guess the next move is almost impossible. I will tell you, there's enough skepticism around to make me wonder if we're going to go still higher.
Okay, that's good. Enough skepticism to maybe make us go higher. Jack Hough, what do you think?
Earnings say that prices are average right now, spot on average with their historic average, but earnings aren't the only thing that matters. What matters right now is 0.1% that people are getting in their money market accounts and in their banks. They've been sitting on the sidelines. They've been watching the market go higher, and they're thinking, my husband or wife is going to clobber me for missing out on this rally and getting next to nothing on my money. I have to get involved. So this is, I think, begrudging buying on the part of people who are saying, I have to get into this thing.
Great point. Let's bring in Dave Callaway from Market Watch in San Francisco. Dave, is Jack right? We're going to have a sucker's rally maybe. All the small investors pile in. Definitely the time to get out if that was the case, right?
Well, the question is, has the last 2 weeks been a sucker's rally, Simon? I think Jack has a good point. The Fed wants people, the Fed's keeping rates low, so people will invest in riskier assets, and it's finally started to hit. And we've seen the market over the last 6 or 7 weeks. 13,000 is a meaningless number, but as Jonathan pointed out, it adds confidence to people. It gets people starting to think maybe they need to be part of that. And so my guess is that we're closer to a short-term top here. But we may take out 13,000. We may take out NASDAQ 3,000, which would be the highest level in a decade. And more importantly, as Mark Colbert pointed out on Market Watch today, the Wilshire 5,000, which represents the entire stock market, is only 1.5% from its record close of October 2007. We could take that out. So all of that points to a rally that's really been striking the last 6 weeks, but probably is nearing at least time for a breather.
Okay, so Jack, I'm hearing $4 gasoline inevitable fairly shortly. I'm hearing the Greek situation will not hold for very long. It will again lurch to another disaster. This doesn't sound good for the economy. Is this just, time to get out, take your profits, go?
I don't think necessarily. Look, it's one thing to have low interest rates. It's another thing for the Fed to guarantee to say, look, rates are going to stay extraordinarily low until 2014. You're a guaranteed loser if you're in short-term money right now because inflation is 2 to 3%.
You're a guaranteed loser unless stocks go, the Dow goes to 5,000, in which case you'll be a guaranteed winner. Right? I mean, I'm right.
You have something in the stock market. You do have some basis for the value of the market. You have a couple of percentage points as a dividend yield, which beats anything you're going to get in a money market.
Yeah.
You do have strong earnings right now. It's not to say that it couldn't go lower. It's just this is the choice that has been created here by policy. It's either guaranteed loser in short-term cash or take a shot at door number 2, and that's where people are heading.
And Brett, door number 2, is that looking good to you? Those nice juicy dividend yields, or does the risk, the volatility, worry you?
Well, look, I mean, the dividend game, people have been waking up to this for a while. It probably hasn't all been squeezed out, but certainly it's not a lonely trade anymore. It's amazing the number of people who say, oh, well, I'm looking at stocks that pay high dividends. It's like, wow, these people seem to think they're the only ones. Look, the real issue isn't what happens next short term. It's the fact that all of this is fueled by basically free money. You can't manufacture wealth with a printing press. Sooner or later, that free money, essentially gets withdrawn. Sooner or later, you can't quantitative ease forever. And that's where the problems come in terms of a stock market that's been juiced up and people who've basically been forced into the market by this quantitative easing policy. The more serious issue is what happens in the medium long term, what the returns are like over 3 or 5 years rather than maybe over the next 6 months.
And that's a very good point. I want to bring Dave Callaway back. Dave, basically the stock market on steroids, on cocaine, on speed, you name it. That's what Brett's saying. What when the drugs are withdrawn?
He's got a very good point. The key is, when will the drugs be withdrawn? 2014, 2013, or next week? Most likely not for a while. You know, like we said, like you were talking about with Jonathan before, inflation, oil starting to tick up, but nowhere near where it needs to be for the Fed to end its policies. So we could go on for quite a while, and that people are choosing to make their bets, as Jack said, with stocks for the time
Jack's
being.
I think one thing you can do to protect yourself, if you want to buy now but you're worried about everyone buying at the same time, look, there are sectors of the market that are overbought. Everyone has crammed into staples like peanut butter, other foods. It's overbought. Utilities overbought. Look at the ones people haven't been buying. Tech, healthcare. There are cheaper parts of the market, so you don't necessarily, you're going to follow a herd into the market. You don't have to necessarily follow it to the same pockets.
So Brett, one of the trades that, like he says, that hasn't been being done, but he didn't mention it, was that gold stocks. They've not been doing very well at all. What do you think of that?
Well, I mean, they have lagged gold for quite some time. Charles DeVoe put that to me last August when gold was booming and the gold stocks were cheap, and he said maybe the equity market is just forward-looking and they're just skeptical about the gold price. It turned out to be a smart move. I would certainly say that if you have no precious metals exposure, if you want precious metals exposure, look at the stocks as well as the bullion.
Okay, that's a great thing. And Dave Callaway?
Energy stocks, if oil's at 106, you got to look at some of those, right?
Well, you know, energy stocks are at 106 because there's a brewing war. Or there's fear of a war in the Middle East between Israel and Iran, and there's problems. I mean, presumably, if we're lucky, we won't have a war, and then oil is back down massively. I mean,
I'm not sure it's not a little bit more than that, Simon. I think I don't think oil would come all the way back to 90 if we had a cessation of hostile headlines. So I'd say energy stocks. Watch oil for inflation.
With energy stocks, you usually get either supply and demand. We've got the demand coming from emerging markets, and we have a supply boom right here in the U.S. right now in terms of these shale plays. So energy stocks make a lot of sense right now, and it could be longer term than people think.